You're listening to the Jennings Journal with Becky Jennings. Becky is a financial and insurance professional and owner of Jennings Insurance Group in Osage Beach, Missouri. She and her team are dedicated to helping individuals and families achieve their ideal retirements by informing them about Medicare, annuities, life insurance, and employee benefits. It's time to write another chapter in the Jennings Journal.
Hello, everyone. Today we're going to be talking about one of the best financial products you've probably never really understood. You're going to want to tune in to the end because this may change your financial life, and at the very least, you may rethink your legacy. When someone says life insurance, you immediately think death insurance. While that may be true in some cases, there are so many types of life insurance, and some will actually limit your financial exposures to risks you may not have even thought of. There are many financial risks that these products can help mitigate. The economic impact these products can have on things like illness, accidents, taxes, retirement, and of course, risks with death. Today, Burke Anglin and I will be talking about one of the most robust financial products you may have never been introduced to in such a way. People often think they can kick this can down the road and worry about it another day. But one of the things that has prompted us to visit about this today is a case we had recently. A few months ago, we had some clients come in ready to retire. And during the course of the case, we redirected brokerage accounts and other financial products into two strategies, income and growth, with the ability to defer taxes. Included in this strategy, we proposed a life insurance contract heavily funded to generate tax-free income deep into the retirement years, which included living benefit. Burke, tell me what happened with this case.
Yeah, we had some clients come in, and as we were working out their portfolio and the different opportunities they had in the portfolio, one of the thoughts that I had and felt very strongly about was to introduce a life insurance contract as part of that portfolio for a couple of reasons. Number one, like you just suggested, not just for a death benefit, but for living benefits. These contracts have 4 different types of living benefits: critical illness, chronic illness, terminal illness, and critical accident. And what that means is if you had a critical illness, let's just say, that would cover like heart attack, stroke, cancer, anything that you'd be diagnosed that would mean that if it continued on, it would be critical. And one of these things is heart attack.
Before you move on, let's talk a little bit more about each of these. What would be a critical illness specifically? Can you give me some examples?
Yeah. So if you go in and you're going through your normal physicals and things like that, or have just noticed that there's certain things going on with your body or your life that isn't normal, you go to the doctor and they run their tests and things like that, and they discover that you have cancer, and maybe it could be in any portion or part of the body, and that would mean it would be a critical diagnosis that if it was left untreated, it would be fatal. The same thing with like a heart attack or a stroke, anything like those kinds of things that left untreated or left unmanaged, it would be probably pretty imminent that you would pass away from those types of things. That's critical. And so if that diagnosis comes down, you qualify for the critical illness portion of a life insurance contract to receive a living benefit from that critical illness.
And that's only if the contract has living benefits. And many policies don't even offer living benefits. So to say that living benefits are available in all life contracts isn't exactly true. So we want to make sure that we're letting people know that not every life insurance contract has these living benefits.
No, that's really true. In fact, if you haven't done or completed any kind of a life insurance review, even in the last decade, my hunch is your contract does not have living benefits. If you've had a contract older than that and you've left it in your shoebox without really reviewing it, you're going to probably be uncovered and wish that you had a review so that if you were going to make some changes on your life insurance portfolio, it would include living benefits. I've been in this business for 33 years, and I started out with Northwestern Mutual back in Sacramento, California, and the only products that we generally had available in those days was a term, what we would call a term product or a temporary product that would last a year generally, or 10 years and 20, and then they developed a lot of term products after that. And then a whole life product. That meant a life insurance policy that if you paid a certain premium, it would last the whole of your life. These types of products never had a living benefit associated with them. So if you've got these older contracts, my hunch is you're walking around with a contract that would meet the benefit of a death, but there's so many more risks out there now medically that you can claim and get a living benefit associated with your contract instead of just dying to get the proceeds of a death benefit.
Also, employees that have coverage through their work, chances are they don't have a living benefit on those contracts either. So it's not just the older contracts, it's also many of the newer contracts. So it's something you specifically should be asking your agent about, correct?
Oh, that's really true. That's exactly right. I would almost guarantee that any group insurances that you're relying on for your life insurance portfolio, it will not have living benefits associated with it.
The other thing too, just a side note here, is if you're relying on a life insurance provided by your employer, please note that when you leave that employer, get ready to retire, what have you, you still will need to apply for a life insurance policy if you want a life insurance policy. And by the way, the longer you wait, the chances are it's going to be more difficult or more costly for you to get a life insurance. We see people in here on a regular basis whose life insurance was tied to their employment, and now they're 65, 67 years old, getting ready to retire, and they're losing their life insurance policy. So it's important to visit that potential loss of life insurance long before you're actually ready to retire, because it can make a huge difference on whether or not you're even able to get the life policy due to maybe you've had a diagnosis or something that might prevent that. Tell me a little bit more about the other types of illnesses and injuries that can cause you to be able to trigger being able to get a living benefit. You know, you said critical accident or injury, terminal illness, and chronic illness. What's the difference between critical illness and chronic illness?
Yeah, great question. But let me back up just a quick little second. You know, you mentioned that if you had an employer-sponsored policy, that it would end at separation. That's probably more likely true. But even if it was portable, meaning that you could take it and take on the premiums yourself after you separated from your employer, it's going to be incredibly expensive. So if you're looking at your life insurance portfolio as only employee sponsored, you're leaving off the table so many more benefits of a personally owned contract long before you might retire. But coming back to the living benefits, you know, you mentioned chronic illness. Chronic illness is one of those things that we're probably all going to face at some point in our life. Typically, the statistics are that everyone will face at least 2.5 years of some type of chronic illness, especially later on in their life, generally starting in their 80s, and then going through the periods of time where they would need assistance. The definition of a chronic illness means that you cannot perform 2 out of 6 what they call activities of daily living. And a physician would have to help with the diagnosis of that, saying you do need help with transferring or with meals or cleaning or the kinds of things that would make life acceptable, that you would have to bring in assistance to be able to do those 2 out of 6 activities of daily living. But once you get diagnosed with that, the living benefit, what it does is it pays a monthly income generated from whatever the death benefit would be, and it will run as long as that death benefit is still had an account balance. And what we're seeing is if the average time frame between a chronic illness that is 2.5 years, these chronic living benefits from a life insurance contract are generally lasting 5 to 7 years or even longer, depending on what the size of the death benefit is.
So what you're saying is someone could potentially, if they cannot do two activities of daily living, rather than going into long-term care, they could potentially trigger that benefit and potentially pay in-home care?
That's exactly right. And the other part of that is, I'll just give you a quick little example. My mom became the primary caregiver for my grandmother. And she did have what we'd call a long-term care policy. The problem with that long-term care policy is she had to go to an agency to be able to hire a medical professional to be able to come into the home. And it was very costly, very expensive. And then that benefit ran out very quickly because it all has limits on it. Conversely, with a life insurance policy, if you get into a chronic illness, it pays you that monthly benefit whether you hire somebody or not. In fact, you don't have to hire a medically trained professional. You can bring in a neighbor or a relative or somebody that does really care for you and really has your best interest at heart. And you can pay them or you can negotiate that pay, but whatever you don't pay them, you keep the difference in what that is. And it does have that death benefit limit.
Okay, so another illness that you mentioned is terminal illness. So can you go into a little bit of explanation for that?
Yes, I can. Let me just say one more benefit on the chronic illness. Generally speaking, when you're talking about a long-term care policy, not only do you have to have the medical trained professional, but you also, it's on a reimbursement basis. You pay the bills first, and then you submit those bills for reimbursement from the insurance company. On the critical ill or the chronic illness on a life insurance policy, they just send you a monthly check tax-free.
Wow.
Yeah. And so now going into the terminal illness, generally speaking, it's a medical diagnosis that you would be terminally ill within the next 2 years. And so what they would do is you could file a claim against your death benefit and they would pay that up front.
So hospice generally is called in when they believe a person's life expectancy is about 6 months. So this can be triggered long before a hospice situation would happen. So why would this be important to somebody?
Well, you think about, peace of mind and some of those other kinds of things, that if they were diagnosed with that terminal illness, they would have the money to get their affairs in order in a lot more effective and productive way. They could hire the attorneys that they need for wills and trusts and make sure their family members are taken care of. And then you can communicate a lot more effectively with the heirs or the beneficiaries on the direction they would like the estate to go. And they've got the money and the time now, not so much time because it is winding down, but the money to be able to implement the kinds of things that you would have if you didn't have the money.
And so the fourth trigger is critical injury or accident. What would mean a critical injury or a critical accident? What would that entail?
This happens probably more often than anything else because these kinds of things happen as a risk of driving down the road or getting in a boating accident or any other thing. You're cutting down a tree on your property and a limb falls on you. All it has to happen, I suppose, to be able to trigger this, and it would be devastating, though it would be that a doctor brought, you brought into an emergency room or other medical facility, and the doctor said that you were critically injured, meaning that if you hadn't met with some medical attention, that injury probably would have resulted in your death. And once that critical injury is diagnosed that way, then you can file a claim against the living benefit and recover just fine. My brother-in-law, he went in for it was diagnosed as a critical critical illness, and he goes in for a quadruple bypass, and he comes out feeling better than he did before he went in, and the doctor gave him another 20 years of good health and recovery. He still could have filed that claim against the living benefit portion of his life insurance policy.
That is amazing. Well, let's fast forward a few months ago during a routine checkup. First of all, let me back up a little bit. We had a client come in, uh, I don't know, several months ago to talk about their situation with their retirement. And so I want to talk a little bit about what happened with this particular client. So he came in and he was going to, they wanted to get their things in order so that they could actually retire. So tell me about some of the strategies that we did with regard to what they had going on, and tell me what you set them up for, and what did you suggest that they do?
Good question. So one of the things that we do when we decide that we're going to try to help somebody retire or move what we call into the distribution phase of their life, that means that whatever they've accumulated, we reposition assets to make sure that they can live the rest of their life with a peace of mind that they know that they can never run out of money. But as we evaluate that, we try to make sure that we uncover any of the opportunities or tools that we have to make a difference deep into the retirement years. And in this particular case that I think you're referring to is the clients came in, we repositioned their assets for income and growth, but also because they were in good health, even though they were in their 60s, we decided that we were going to take a look at a well-staged life insurance contract. And as we began to try to implement that, we were able to implement it, on the wife, and it looked like it was going to provide everything that we needed deep in the retirement years. And as we decided to do it on the husband, for whatever reason, they decided they wanted to put that part of it off.
So wait a minute. You're saying that they implemented all the strategies that you suggested with one exception.
Yeah, I guess that'd be the way to say it. And then months later, he's showing signs of shortness of breath and tightening of chest, and he goes in for basically his physical, and they run a stress test, and they scheduled an immediate quadruple bypass. If he would have implemented that plan, number one, I think from my memory, the death benefit associated with that was $670,000, but he could have filed a claim against that and realized about a $515,000 tax-free benefit while he's alive, and he is in recovery at this time.
Okay, so what you're telling me is this was a client that came in so that we could help them plan for retirement. And it's interesting because, we think about all the things when it comes to retirement, we're thinking about making sure that we can have a quality of life, making sure that we can take the vacations and do the traveling and enjoy the grandkids and all those things, sometimes leaving out the possibility that maybe there is a critical illness that pops up that doesn't cause us to actually pass away, but we still have to get through the situation. And it happens for a lot of people as they enter this particular stage of life. So the contract that we proposed, you said the death benefit on it was $670,000. So if they would have triggered this application, this policy, they would have paid whatever they paid on it, and it would have had a $670,000 death benefit. But due to the fact that he had this quadruple bypass, he could have triggered the critical illness portion of the contract, and he would have received about $515,000 tax-free. And that could have been used to pay off debt or add to his retirement program as tax-free income. So, one of the things I want to make sure that I say here is this is just one example in this one case. This is not necessarily what can be done for everyone. So consider this the disclaimer that everyone qualifies for this, because they don't. And not everyone would have the same benefits described in the example. The client we're referring to had a set dollar amount that he would have put toward this contract. He was 64 years old at the time, and prior to this incident, he was considered in excellent health. So I just want to make sure that we're saying that this isn't the same for everyone. There's a lot of variables here. And I want to make sure we set that expectation so that if someone's interested in this type of program, we need to make sure that we are very clear that it depends on several things as to whether or not you qualify and the amount of benefit that would happen.
Yeah, the other thing about this particular case, I wasn't even looking at the living benefits or the death benefit for that matter as much as I was repositioning assets for later on in retirement income. Because once we house that money inside of a life insurance contract, the money that would have gone into that contract, meaning the premium to fund that contract, would have grown tax deferred and quite nicely, thank you. And so the idea is to get growth inside of a tax deferred / tax free distribution vehicle, because our strategy was that deep into the retirement years that he would pull out an extra income tax free, which would have a direct impact on his Social Security benefits as well as IRMA and some of the other things associated with taking too much income later into retirement. It just so happened that if we would have been able to implement it, it would have also taken care of all the other living benefits. It was a sizable amount of a premium. I mean, it really was going to have a direct impact and a very large impact on his retirement income, not on a living benefit / critical injury, accident, or chronic illness or anything like that.
And by the way, this is a client we adore. They're great people, and we were able to do many things for them. But this is just one recent example of someone that, it's a prime example actually of why we talk about these products. A lot of times folks tend to dismiss something. Again, it's kicking the can down the road on certain things because you think, oh, I'm busy, I'm trying to, stop working, I'm closing down my business, I'm doing whatever it is that you're doing in the middle of getting ready to, move on to the next stage of life. And you just think, I'll take care of that later. And sometimes later it doesn't really work. So anyway, he's in a much better position than he was when we first met him, but he could have been in even a little bit better position now. But I just want to say that I hope this conversation has been enlightening today and hopefully has given folks at home some food for thought on strategies that you may have never considered before. If you would like help finding your retirement solutions, contact us at 573-693-9443, Jennings Insurance Group, or you can find us on the web, yourretirementacademy.com or jenningsinsurancegroup.com. We're happy to visit with you about lots of different products. This is just one of many things that we can help you with that we've discussed today. Burke, thank you for joining me today and going through and explaining what really is a complex, robust financial tool. And this is just one part of that tool. And again, there are many carriers out there that offer this product. But if you currently have a life insurance product and you're not sure if it entails or includes living benefits, bring your contracts in. We'll read your contracts, we'll explain all the intricacies of your contract in detail. And we'll go over them with you so that you know exactly what you have. If you have a cash value, we will help you figure out what that is and maybe see if we can leverage some of your current contracts in a little bit better position than you have them currently. So again, thank you for joining us today. Check out yourretirementacademy.com or give us a call at 573-693-9443. Thank you.
This has been another chapter of the Jennings Journal with Becky Jennings. But the story doesn't end today. For more great content, visit thejenningsjournal.com. That's thejenningsjournal.com. You can also find the podcast on Apple Podcast, Spotify, Stitcher, and Google Podcast. And if you have any questions about the content on today's episode, send Becky an email at info@jenningsinsurancegroup.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of insurance products to custom suit their needs and objectives. We are not affiliated with the Social Security Administration or any other governmental agency. We do not offer tax, legal, or investment advice. Always consult with qualified advisors for your own tax, legal, or investment needs. Any references to protection benefits or steady and reliable income streams from this podcast refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are backed by the financial strength and claims-paying ability of the issuing insurance company. Annuities are insurance products that may be subject to fees, surrender charges, and holding periods which vary by insurance company. Annuities are not FDIC insured. The information and opinions contained in any of the material requested from this podcast are provided by third parties and have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. They are given for informational purposes only and not a solicitation to buy or sell any of the products mentioned. The information is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation.